you an NFT artist or seller? If so, you may know that sales taxes may apply to your NFT sales. The problem is most sellers are currently not complying with sales tax regulations. A large reason contributing to this non-compliance is lack of awareness and understanding around sales tax laws as they relate to digital assets and NFTs. In this video, I'm going to go over when NFT sellers should collect sales taxes on the sales of their NFTs. When you're determining the sales tax applicability to any given sale for an NFT that you're selling, we're going to need to consider a few things that are going to impact your overall taxability. The first is your nexus and sourcing, which relate to the tax jurisdiction that you're being taxed in. And the second is the product taxability that will also be related back to the jurisdiction that you're taxed in. So in order to get this information, we're going to need a couple things from your customers and from you. The main thing being, we need to know the location of both your customer and of you as the seller of your business. With this information, we can start to parse out the taxability by determining what is the sourcing of the sale based off of your location and your customer's location, what's the nexus of the sale, and then based off of that, what product taxability applies to this sale. And then with this information, we can arrive at an accurate tax rate that applies to this sale. So what are some of the considerations when we're talking about nexus and sourcing? First, there's physical and there's economic nexus. Physical nexus is fairly straightforward. If you as a seller have a physical location in a state, it's likely that you're going to have a nexus based off of physical nexus. This can be an office, a warehouse, employees in an office in a different state from your headquarters. If you have a physical location within a state, it's likely you're going to have a physical nexus and have to collect sales taxes according to the product taxability rules and other regulations within that state when you're selling to sellers within that state. The other jurisdiction that we need to understand is economic jurisdiction. There's a few different considerations that can go into economic jurisdiction, such as click-through and affiliate nexus. What I really want to focus on is the economic thresholds of the dollar amounts that you're selling and the amount of NFTs or amount of units that you're selling of your product. In most states, if you reach a certain threshold, in many states it's $100,000 or 200 units, but the dollar amount and the units can vary state to state. But if you reach these certain thresholds, you'll be referred to as a remote seller. And in addition to the state that you have a physical nexus in, you can have a remote nexus in states that you exceed these thresholds. So you as an NFT seller could possibly have nexus in 30 plus states if you have a physical nexus in one state, but then you're selling in say 30 other states and they all have an economic nexus associated with it based off of the volume that you're selling to customers in that state. You can have a nexus in several different states, which, as you can imagine, creates a larger compliance burden and compliance risk for you as the CEO of your business. Now, outside of the nexus considerations, we also want to consider sourcing. So there's two different types of sourcing. There's origin-based sourcing, there's destination-based sourcing, and then there's hybrids of both of those. Most states are going to be following destination-based sourcing. Destination-based sourcing is basically going to look at the tax rate based off of the location of the buyer, whereas origin-based sourcing is going to be looking on a tax rate based off of the location of the seller. Usually with origin-based sourcing, there's a modified approach to this for remote sellers, where when you're remote selling, even if you're origin-based for your physical nexus, usually it'll change over to a destination-based for remote sellers. But this will vary state to state, but it is an important consideration to make sure we're getting the correct tax rate. Even if we source the sale correctly and we get the right nexus, if we don't choose the correct sourcing method for the tax rate, we still can be off in determining what tax rate applies to the sale. So it's very important to get this accurate. Once we've determined our nexus and our sourcing, we have our tax jurisdiction. Now, based off of this, we can determine ultimately do sales taxes apply to this sale or not? And this is going to now depend on product taxability. When you're selling an NFT, they're going to be looked at based off of the overall nature of that NFT. You may be selling a standalone NFT, which can be taxed one way within a particular state, or you may be selling NFTs that are being purchased in order for your customer to acquire an underlying good or service that's represented by that NFT. And additionally, there's the consideration of royalties in addition to these different types of NFTs that people are purchasing. So depending on the type of NFT and depending on the state, there may be sales taxes that are applicable to this sale or not. Currently, we've seen several states provide guidance specifically on NFTs and on standalone NFTs and on a taxable hierarchy depending on the type of underlying products within NFTs. Washington is the most notable state for this, where they're taxing standalone NFTs. They're taxing NFTs where the underlying product is already taxable within the state. And then if there's NFTs where you're selling where the underlying product was not already taxable in Washington, then these NFTs aren't taxable. Another interesting thing about Washington, while I'm speaking on them, is that they also tax royalties with a business and occupations tax. So it's very important that we get this product taxability right. And what we want to do is we want to understand what is the NFT that you're selling. Is this a standalone NFT? Does this NFT represent a specific good or service? And then based off of that, we want to understand the taxability that applies to that within that given state. Now, in addition to states that have given guidance related to NFT sales taxes, there's over 30 states that already have sales tax regulations related to digital goods and digital products. These tax rules likely apply to NFTs since they're going to likely fit the definitions that already exist for these product categories. In fact, states that we've seen that have given preliminary guidance related to NFT sales taxes, such as Washington, such as Pennsylvania, Wisconsin, they have noted this, that the guidance they're putting out related to NFTs are interpretations of existing guidance related to digital products and digital goods. So, this is something to keep in mind. Even if there are states without specific guidance, we still want to be looking at the NFT that you're selling and understanding the overall nature of it to determine how does this fit into existing sales tax regulations. So there are challenges to collecting sales taxes on your NFTs. The first one is just generally speaking, there's a level of anonymity, or at least a desire for anonymity for people transacting with non-custodial wallets. They have a perception that the blockchain is anonymous. The blockchain actually isn't anonymous, it's pseudonymous. And either way, they, may be hesitant to provide their address to an NFT marketplace or to a seller that's selling on a mint page or selling on a product page. But there's no way to get into sales tax compliance without this. There's also a large risk for the customer purchasing it with use tax exposure. So this is going to have to be something that industry-wide we see some maturation. And if you're purchasing NFTs and you want to be compliant from a tax perspective, your customers are going to have to provide this information, and you're going to have to collect this information as a seller. So the first challenge is really just getting that customer information and also doing so in a seamless manner at scale. So when your customers are making purchases or making mints, there's not friction that's going to cause them to not complete their transaction because we're requesting this information. And what's really needed to achieve this is an automated solution that's collecting your customer information seamlessly and then allowing them to mint. That's what we created at Digital Impost. So the first problem is collecting your customer information. The second issue is determining a rooftop accurate tax rate that's quoted in the native cryptocurrency that's used in that specific transaction. This again goes back to making sure that this is a seamless checkout or minting experience for your customer. And we don't want to give them any reason to not want to complete the transaction just because we're collecting and calculating this tax information. So the first challenge is actually getting your customers' information, and then we need to make sure that we return them a rooftop accurate tax rate in their native cryptocurrency. These, I would say, are the two biggest challenges. There are additional challenges when it comes to NFT sales taxes in terms of just making sure that, you know, we have our tax reporting correct and we're maintaining all the documentation. A lot of this can be automated with Digital Impost or another automated solution that's collecting all of the tax reporting information on a back end. But the two big things really on the front end when you're dealing with your customer is collecting their information and then quoting them the correct and accurate tax rate based off of all the tax rules in their native cryptocurrency. So what are some of the risks with not collecting sales taxes when you're selling NFTs? The first one I alluded to slightly, and that's retroactive taxes. Because NFT sales taxes are interpretations of existing tax laws in most states that relate to digital products and digital goods, these laws were already on the books. So if you've sold NFTs in the past 3 to 6 years, these states can pursue you for those back taxes, since technically those were taxable sales and these rules were already on the books. Even if that state just comes out with NFT guidance, say this month, if they're gonna have it fall under the definition of digital products or goods that were already well defined, retroactive taxes likely apply. We've already seen multiple states already state this, including Washington State. So retroactive taxes can be a huge risk because this will be the state coming back to take tax liabilities from you that you didn't collect from your customer that are going to come at it your bottom line, and it'll be an unexpected hit to your company's cash flow. So that's a big risk, retroactive taxes. In addition to retroactive taxes, we have penalties and interest for underpayment or just total non-payment of your sales taxes. The exact penalties and interest can vary state to state, so I'm not going to get into rates, but these can be very prohibitive. In addition to the retroactive taxes, it can really hurt you from a cash flow standpoint because this is just going to be coming out of your bottom line, and it's going to be unexpected because you're just going to get a tax notice in the mail one day. So retroactive taxes, penalties, and interest. Then another big consideration is just legal actions that the state can take in terms of coming after you criminally for not complying with taxes, or even coming after your business with cease and desist to stop you from selling further until you comply with taxes, or just in general. So we want to make sure that from a legal standpoint, we don't run into any headaches that can impact the continuity of your business as a result of non-compliance with sales taxes. And then another consideration is use taxes. So if you're selling to your customer and you're not collecting sales tax from them, they should really be claiming the use tax equivalent of that on their tax return, so they still pay the taxes for that associated sale. Now, most customers are not going to take this step. They're not going to pay use taxes. So what happens is, as a result of them purchasing your NFT, you're creating a huge tax issue for them that can create compliance issues down the line for them. And if this happens, you need to be concerned with damages to your reputation, unhappy customers, impacts to your business continuity if they're not coming back to purchase more NFTs. So that can be a big hit to both you and your customers. And just staying on this reputational topic in general, if we start getting headlines about your company or just the industry as a whole about not paying your fair share in taxes, not paying any sales tax liabilities, it's going to hurt things from a reputational standpoint and from a public relations standpoint. So there's many risks associated with not collecting sales taxes on your NFT. Are you an NFT artist or seller that's worried about sales tax compliance and you need an automated solution that can help you from checkout to tax reporting and everything in between? Look no further than Digital Impost. Me and my team identified the need within Web3 for a sales tax compliance automation software that's native to blockchain and NFTs, and we built it to ensure that you and your team can get into compliance and continue selling NFTs. Contact me and my team today at Digital Impost in order to get you set up to continue selling NFTs while remaining in compliance with sales tax agencies.